right. Good morning. Good morning. We got a nice group of people here first thing in the morning waiting for the big show. It's nice to see you guys all here. Glad you get up and make it every morning with me. It's nice to see you. All right. We have fun, don't we? All right. That's the whole reason we're here is to have fun, make money, and see if we can have a little fun along the way. So, all right, guys, let's say hi to a few people. We got John saying hello. It's nice to see you, John. There we go. And we got Albert saying hello. It's nice to see you, Albert. Glad you could make it. And we've also got Kirk saying hello. We got a bunch more people saying hanging out in the room than are saying hello. So if you guys want to put up your little marquees and say hello, we'll make you famous. All right, let's come in here and start talking about. First of all, I want to do a little analysis on what the market's doing right now. We're all very interested in this crazy market that's been going up and down just so randomly because, oh, Mr. President's doing all kinds of crazy things. The fact is, the market is actually moving, traveling through price and time like a train on rails. All right. It is making the most classic moves that any market could ever make. I mean, it's just like perfect right out of the manual. The manual. What manual? Of course, there's a manual. The manual to the class. It's online. Go get it. Amazon. Search Lan H. Turner. That's all there is to it. It's 238-page manual. It'll help you understand all this stuff. All right. So let's go do that. And what we're going to do now is we're going to go through and talk about the patterns that this thing is making. And then we're going to go over and we're going to look at our UBI portfolio. Our UBI portfolio, of course, is universal basic income. Everybody's concerned about having income, especially those people who are worried about AI taking their jobs. And I'm on a forum in Facebook, and these guys are always, all the time, every day, I see a post that comes along. Oh no, how are we going to solve the problem with AI taking everybody's jobs? And every single time you get, I swear, every day there's somebody in there that says, we need to tax everybody. We need to tax the rich, tax this person, tax that person. Get the government in there to tax everybody and give us money. Give us money. The government should give us money. I'm just like, oh my gosh. Why do people always think the answer is to have more taxes? And so I'm always in there saying, hey guys, how's that worked out for us with the old age UBI? Right? Universal basic income for old people. It's called Social Security. How well has that worked out? Worked out like a charm. Federal government been really good at that. They've been managing that like a charm. Oh yeah, we love the way the government manages UBI. Let's have them do that for us when we lose our jobs from AI too. Yeah, the government, they're so good at managing our money. Not. All right, let's look for another solution, shall we? Let's look for another solution. I think the solution is in the stock market. And I think that what we need to do is we need to look to the stock market to figure out how to get more money in the future if we lose our jobs. Now, whether that's by old age, by injury, or by AI taking our jobs, I think the best way to make money is in the stock market. And that's going to be your source for UBI. So I have a UBI spreadsheet that we're going to go through and we're going to update it. And we're going to show you how much money we've made so far this year in our UBI, Universal Basic Income strategy. And I've actually, on my personal spreadsheet, I got two spreadsheets. I got 7 accounts. I got 7 trading accounts and trading and investing accounts. But I've totally rewritten the spreadsheet from top to bottom, almost completely. It doesn't even represent the one that I've given away to you guys. So I got to get that updated. I'm working on it yesterday all day long, worked on it Saturday all day long. And it's completely, just doesn't even look like the old one. Well, that looks like the old one. It's representative of the old one, but I've made so many changes in it. And I haven't reflected that over in anything else, just my own personal one. So I need to take that model and then I need to replicate it 8 times for my 7 accounts and then for the one that I give to you guys. So I've got something else coming to you too, that big old spreadsheet, and I've worked on it forever. So I give it to you for free though. Well, for free. It comes with your Pit News Magazine subscription. Pit News Magazine, what's that? Oh, I'm glad you asked. Let's see, Pitt News Magazine. How do I get me out of the way so you can see the URL? There we go. Pitt News Magazine is the magazine that we write here for the channel, right? It's the channel magazine. And of course, I teach at the university, and so it's the university class magazine, and it's all the things that we talk about in class, all the things we talk about here at the in the YouTube channel, which is actually the lab for the university class. And so we teach all kinds of great things here, and we put them into Pitt News Magazine. And when you subscribe to that, you can get it right now for $19.97 for a whole year. I mean, that's all 12 issues. Regular $39.95. You use that 50% off code. That is the code, 50% off. You put that in there. There's a little blue arrow. You click it. Boom! It knocks off $19.95. You get it for $19.95, and then you're going to get all these spreadsheets. All right. So that's how you get the spreadsheets. And I'm also working on the poor man's covered call spreadsheet too. So I got that pretty much to a point where I could probably give it to you. It's not very pretty, but not got the color headlines and stuff. So I'll get those put in there. But we'll probably, if we have a chance, we'll look at that today too. But I'm going to come in and make sure you get your Pitt News Magazine. And why do I have to remove this one first and then add this one in? Why can't I just flip? It used to let me flip. It's crazy. I don't know. I don't understand why they make it harder on you. Anyway, nonetheless, here we are looking at the S&P 500. So this is the, oh my gosh. Are you guys having problems with this springtime thing called, what do they call it when you allergies? Man, I've been having the allergies. Yesterday, I took the allergy pill. That Zeke, anyway, whatever it starts with a Z, knocked me out cold. Holy cow. I couldn't walk. But it worked. I stopped coughing and sneezing and runny nose and everything. I mean, it's all gone. But knocked me out cold. 6 hours. I still laid on the bed because I couldn't. So I don't know if it does a whole lot of good there. I mean, it's going to knock you out to the point where you have to sleep for 6 hours. What good is the pill, right? You take the pill, at least you're not coughing and sneezing, but you're also dead to the world, sound asleep. Anyway, so I haven't taken that pill this morning, so you're going to have to bear with me. I don't want to fall asleep in the middle of class. All right, here we come. Here's the peak right here. This is the big top right there, right? We always talk about the very peak of the market, and it came across here and tried to break that several times. So we had 3 tops on this market. We had one here, we had one here, and one here. That was the giveaway. That was a big giveaway. Of course, if you came to the monthly chart and looked at the monthly chart, this was the big giveaway too. Right? So we're going to come in here and get rid of all of our projection tools. But this was pretty big giveaway right in here, where this market came in. And this is all we're trying to do. We're trying to reverse engineer BlackRock's, Wall Street's mathematical models that they use to trade with, right? They're quant systems. And so this is they use Fibonacci in their systems. And they use Elliott wave strategy, they use accumulation distribution, they use dollar cost averaging, and that's how they do it. And they buy low, sell high. That's really all there is to it. But we want to know when they're going to do that, right? So that's what we're doing in this class. We try to reverse engineer Wall Street's mathematics, and I'm pretty good at it. You know, I'm not the best. Well, I probably am the best. That's why you're here, right? I'm pretty good at it. We're pretty good at it in this class, aren't we? We're pretty good at reverse engineering what they're doing. So they ran this model through this perfect setup right here, right? A, B, C, D. Went right to 100%, just like, say it with me, a train on rails. And then this becomes what we call the Fibonacci bow tie. All right. So a Fibonacci bow tie comes in like this, and we go down, we go up, we go here, we come back down here, and we tie that bow tie off with the A point, because that's the little pattern that we look for. Now, the only thing that happened with this one that's a little unusual is that it came down so fast. Not the numbers. We wanted to see that bow tie be a little bit slower like that. But, you know, it's like ripping a Band-Aid off. It came off fast. So, okay, that's fine too. So we've got this little bow tie, and it made a perfect bow tie. Look at that. It came right back down to the Fibonacci bow tie, just like it. Say it with me. Train on rails. All right. So it came in and made a perfect bow tie. The only difference is it came in a little fast. And so that's that pattern that we look for. And you're like, what? What are you talking about, Lan? Yeah, it does it all the time. Watch this. Here's one. The one just previous to it went up, went down, came back, tied it off with the bow tie. We can go back and look at little bow ties all the way down. Now you have to go stretch out the market because it's, the scaling is a little off, but because of this, how big this market move was. But that's what we look like. And that's on a monthly chart. So each bar represents 1 month period of time. Don't forget to look at your long-term charts. Lots of people forget to look at the monthly and the weekly charts. Got to look at the monthly and weekly charts. They have lots of giveaways on them. All right. So there you go. That's what's happened. This market came right down. Now it's rebounded quite significantly, come all the way back up to where it touched those blue lights in there. Is that important? Yeah, it probably is. Watch this. We're going to come down here to a daily chart. And what's happened is down here on the daily chart, here's that little ABC pattern right in here, right? So we come in A, B, C, and again, it came right down to what we call the Fibonacci golden ratio, which on the projection side is 130.9. Came right down to it. Now, 100 is also very important, but it blew past 100 like it wasn't even there, right? On that little flush right there. Okay, so it flushed down. That was the part that was a little unusual, how fast it came down right there. Now they're gonna say that the tariffs had something to do with that. I'm gonna say, okay, you can say that if you want to, because retail traders are the ones that get affected by that type of news and events and stuff. The big banks, hedge funds, BlackRock, Vanguard, those guys, they're not as affected by that stuff because they're looking for long-term moves, right? They're looking for big moves like you see on the monthly chart. The daily stuff, this is for retail traders. They move this stuff around, but they like to take advantage of retail traders. So they're running their quant systems on all time frames, of course, obviously. And so this market's come down and it hit that 130.9 pretty darn close. Now, the one thing that the big banks and hedge funds can't do is they can't control completely what, the motivations and the fear factor of the small speculator, but they do pretty good job, and they build all their models, as we talked about last week, all their models around this fear factor here. So you got optimism, enthusiasm, exuberance, euphoria, anxiety, denial, fear, despair, panic, capitulation, discouragement. This is where we all sell, right? Retail traders. So we all buy up here and we all sell down here, and then they have dismay, hope, relief, and optimism, and then we start the whole process all over again, right? Repeat until we're broke. So that's how the big banks and hedge funds run their quant systems, based on this psychological fear and greed factor that we retail traders work with. All right, so that's the name of the game for them. And so you can see that pattern, or that you can see that built right in right here. Where are we? We're at optimism right now, aren't we? We're at optimism. So do you have optimism today? Did you get up and look at the stock market, and did you have a little optimism? Did you come in here, and did you have optimism over here? See, right in here. Did you have a little optimism? How about back in here? You were like exuberant euphoria, right up here. This was exuberant and euphoria. You guys, we were all making so much money, we didn't know what to do with it all. We all had exuberance and euphoria, and then it started to flush. And then we went down through anxiety, right? And then we had denial, and then we had fear, and then we had despair and panic and capitulation and discouragement, and all the way down into here. And finally, we've come down in here, and we're back at the optimistic range. So what happens at optimism? Well, we start going up into euphoria, exuberance, and I don't want you to get too excited, because oftentimes what happens is this market right here will come back up. It'll hit those blue lights. And we've seen it a million times, haven't we? We see it on a 1-minute chart. We see it on a 2-minute chart. We see it on a 15-minute chart. We see it on a daily chart. We see it on a weekly chart, monthly chart. What happens? It comes up, hits that blue light, and it flushes and turns around and comes back down. Now, it doesn't have to. Doesn't have to. We have seen where the market just has what we call a V recovery. And it just goes way up and just keeps going. And then you have this top right in here. So this would be a V recovery area that's very important for the market to go up and try and break above that. As soon as it breaks above that, we're going to look for the market to continue to rise. But we need to have a little ABC pattern in here. We got to have a little bit of, if it's a normal market, and we know that this thing's anything but normal right now, but it's actually been pretty normal, believe it or not. This is pretty normal market. So if it actually is a normal market, it's just hit that blue light. That blue light will flip down here to the other side. And that'll happen because it's a daily chart. It'll happen tomorrow. It broke it, so I think it'll do it. So then we'll see this thing flush back down. All right. So we generally get it to go up there. And then I think this week, by the end of the week, we'll be back down in here somewhere. So if you're like, oh no, I missed the bottom and I can't, oh, what am I going to do? I'm fear of missing out, right? And you want to buy, and you want to buy up here. Yeah, if we have a V recovery, then yeah, maybe you'll feel bad, but it'll probably just still come right back down to this area again anyway. And so just, you got to sit on your hands sometimes. This will be another buying opportunity. It'll come up here and everybody will buy here because they like to buy high, right? Where do they like to buy? Retail traders like to buy right up in here. So this is where this market's at right now. Let's shrink this down a little bit, bring it down in here. See that? Where are we at in the pattern? Where are we at? Okay, this little pattern right here. See that? That's this little pattern right here. Of course, it happens on a longer scale too. But this right here is this pattern right here. See? So where are we at? We're on optimism. So what is optimism? Gets us up into euphoria, exuberance. So there's the possibility this thing will roll up in here, right? A little bit higher. But it's probably going to make some sort of a move like this. It'll probably come in and, well, just draw it like this. It'll probably come up like this, right? And if it dips down that far, I don't know. And then maybe we'll get something back up like that. All right, so that's the kind of, and what is that pattern? What is that pattern? That pattern is a head and shoulders formation, right? So if we come in here, grab our head and shoulders tool, go off this left shoulder, this neckline, the head, the neckline. Let's clear some of this stuff out. I got too much stuff going on in here. It's just a simple head and shoulders formation, right? But the problem is that we're having this head and shoulders formation right in here. And I think that we got a natural trend line that goes off this top down to this line. So we're going to bring this down a little bit, right? So like that. That's your natural trend line. So if this neckline goes up and matches that natural trend line, it'll be up in there somewhere. Then we'll get that little right shoulder. Now, the problem is we're still in a downtrend. Boy, I almost didn't get to the mute the mic quick enough. All right, so here we go. So this is a little downtrend. This just doesn't look like a head and shoulders to me. It still looks like a downtrend. So I think we're going to get another one. Could we get another, a whole nother head and shoulders clear down here? We certainly could. That would be our 3-drive pattern to the downside. Drive 1, counter trend, drive 2, counter trend, drive 3. All right, but it would have to come down and it would have to break below this point here. So we may not get that because that's already matched over here on the monthly chart. That's already matched our Fibonacci bow tie, right? It already came back and touched that previous high. So if we come over here, I think we're still going to get that right shoulder. It just may not break down. Just may not break all the way down and break this bottom. And if that's the case, we're going to get a little bit of a pullback in here. So you guys who felt like you missed the bottom, I think if you just hold on, hold your shorts a little bit, you're going to get another opportunity to buy down here. It may not be this very low, but most people didn't catch the very low anyway. Anybody who started to get in probably got in like right up in here on this crazy day or up in here somewhere, started to get in. So I think we're going to see this thing come up, and maybe we get maybe another day. We got none of these are, well, that's we got 2 flat bottom bars and this crazy little bar, but we've got 4 up bars. 5, 1, 2, 3, 4, 5. That's pretty rare to get more than 4. So we got 5, and then we get we hit our blue lights, and then I think it's going to flush. I think we're going to get a little flush in here. But we got this neckline right up in here, so that's kind of a little area of resistance. And then we got to come down and make this little right shoulder. How far down is the right shoulder going to be? Well, we don't know, but usually it's somewhere on that delta cone of probability, right? So if we put that up there, we're going to probably see that market back down into this region here. So that's my projection. I think we're going to see this market back down in here. If it's strong, it'll just barely come down, maybe touch the 38.2 and go back up. But if it's normal, come down to 50, 61.8 and go back up. All right. The media is going to go haywire when that happens. All right. Watch that happen. So it's just normal profit taking. It's just normal one standard deviation stuff. So don't freak out yourself. We've got this one standard deviation from the top here to the bottom here that we got to take into consideration because they're taking it into consideration. All right. You got to realize that that's what their mathematical models do. And so that's the Fibonacci sweet spot, the delta Kona probability. Where are we at right now? Almost dead center of the delta Kona probability. What is the delta Kona probability? Well, I'm not going to go into it today because it's a little bit beyond the scope of this class. I've covered it a number of times in previous classes, but you guys who have been here, you know what the delta Kona probability is. You're doing this reading, and of course, I know you're all great and wonderful traders at this point because you've been coming to this class and you know all this stuff. All right. So you're not scared. You haven't been worried because this market's been doing everything just like it should, just maybe a little bit faster and with some bigger bars. That's it. But nonetheless, it's following everything, all the patterns, just like a train on rails. There's nothing extraordinary about this market other than how fast it made those bars. That's the only thing, how fast. So, you know, things got a little nervous in here. That's it. Little nervous, nearly, but it's nothing really out of the ordinary. Too out of the ordinary. So that's what we got left. We got this little right shoulder and a go. And if we go for a third drive, it could come down here and break and go one more time. And remember, we generally get, two of these is standard for a reversal and a bull trend. A lot of people are saying, well, the market's down a certain percentage. That means it's a bear trend. No, that's just random. Come on, dudes. Come on. That's not what that means at all. It's just random if you start randomly pulling shit out of your ass like that. That you can't do that. You got to do the mathematics. You got to do the modeling. When are we in a downtrend? What's the definition of an uptrend? Higher highs and higher lows. Definition of a downtrend: lower highs and lower lows. What's normal? 3 drives up, 2 drives down. That's normal. Right now, we're normal. This is just normal stuff. Is it a little bit more than normal? Well, you could say so, but I'm going to say no. It's not even more than normal. It came right back down to the previous high, created that Fibonacci bow tie. I mean, you couldn't draw it any better if you drew it in a manual in a book. All right. I mean, it's so perfect. The only thing that was a little unusual is how fast that bar came down. It should have come out a little bit more like out in here. I mean, it should have been a little bit slower in its downtrend, which means that we may not be done. This thing may still come out in here, and it still may come back down in this region before it goes back up, which would be normal. All right. So are we in a downtrend? Are we in a bear market? No, we're not in a bear market. Why? Because we're still making higher highs and higher lows. The only way we'd be in a bear market is if this thing turned around and started making lower highs and lower lows. And we haven't done that yet. So all these analysts on TV, oh, we're in a bear market because the market came back 10%. That has nothing to do with it. Look at how big the market's been moving in the past. It's been moving in large. You can't come back here and say, well, back here, 10% was a bear market. Well, that's not the same market as what we've been in the last 5 years. All right, 6 years, a different market. You can't use those same metrics. So those guys who are just those random TV analysts, they don't know anything. That's why they read teleprompters. All right. So this is how you have to do it. Higher highs and higher lows, lower highs and lower lows. That's the difference between an uptrend and a downtrend. That's how we can definitively say the market is in a bear trend or a bull trend. And it is now making lower highs and lower lows. So can you say that's a bear market? Yes, technically speaking, to some degree, but it's not overall because it didn't break this low here on the long-term chart. It didn't break that low. So it's still in an uptrend. It's still just making standard higher highs and higher low markets. It came back, pulled back to this high, but it never did break that low. So technically speaking, we're still making higher highs and higher lows, higher highs, and higher lows. Technically, I mean, it wouldn't be in a bear market till the market broke that level right there. Oh, that's a long ways down, and it's going to do a lot of bear market stuff on smaller, shorter time frames. But on a monthly chart, on a long-term thing that really matters, that's the bear. It's a big move, I know, but it is what it is. I can't change the rules. All right, the rules are what they are. So on a daily chart, are we in a bear market? Well, not really, because this is just a standard 2-drive pullback against an Elliott wave pattern, right? What's an Elliott wave pattern? Elliott wave pattern is 3 drives. Drive 1, drive 2, drive 3, and then you get an ABC pattern, right? That's a standard traditional pattern. So you come in here and you go off the bottom, you go to the top, and of course you do all the little ones too, right? You do little one in here. These are just your little delta cones of probability going in one standard deviation, and then you go to the bigger one. So then we go to the bigger standard deviation, which is this one, and we come back into this region here, and it's just normal stuff. Yeah, but Len, it's lower highs and lower lows. Isn't that a bear market? No, that wouldn't be a bear market. It's just a little small retracement in the overall bull market. So if you're looking on the monthly chart, yeah, it's a big move, but it's still nothing normal. It's not out of the normal range. I mean, it's still in the same pattern. So what happens here? Well, generally speaking, if we're in a bull market and a bull trend and economics are doing well, we would expect the market to turn and start to do this, back up 3 more drives, right? If that's the case, we end up with what we call a little head and shoulders formation right in here. And that's your little bottoming pattern, changing from lower highs and lower lows to higher highs and higher lows. And that little natural trend line break right there, that's your indication that we're back up doing normal things. So is this a bear trend? Yeah, I mean, you can say, yeah, it's a bear trend, but the overall longer term move is still bullish. All right. It's called fractal trading. Fractal, meaning that, yeah, on the smaller time frame chart, daily chart, it's bear market. But the overall big trend is still very much bullish, very bullish. All right. We haven't broken this natural trend line down here. We just come in, technically speaking, if you want to call that drive 1, drive 2, we could go for a nice big drive 3 right there. But this market's drive 1, drive 2, drive 3, drive 1, drive 2, and we drive 3. Is that what's going to happen? I don't know. I don't know, but that's what the numbers are telling us, right? That's what the numbers tell. This was Corona. And so this is kind of a whole new market in here. We don't really understand how this thing's going to play out because it's just a whole new market. Could it be a head and shoulders top formation? Yes, it could. Could come up here, come down, make this, go up, fail to make a new high, and then it would flush at this point. And man, that would not be a happy thing because then we would expect it to come down into this region. So if it turns around and starts trying to go back up, right? Starts trying to go back up right in here. Let's go right off that low. Let's say that's the low. And it tries to go back up and it fails to hit that new high up in here. Woo-hoo-hoo, baby. You're going to expect that flush all the way down to here. That's when we would hit a bear market. Now, could this be a bear market? It could. Then that's what would cause that bear market. It would come up here and not be able to break that previous high. And that'll be a real telltale sign. If we can't break that previous high, you better gird up your loins because that baby's coming down to here. All right. So there we go. That's my analysis of this market. But right now, we're getting this little, it's just too sharp. It's too fast. It's got to flush. It doesn't have to do anything. It doesn't have to flush. But my expectation is that we're going to get a little pullback in here, back down into the Fibonacci sweet spot, right down in here somewhere before it makes that next rally up. All right. If it even makes the next rally up, because we could go to 3 drives down, drive 1, drive 2, drive 3. So that's where we're at. That's what we're looking at, guys. So keep a little powder dry so you can put it in on the pullbacks. We got 2 of these so far. This one back here doesn't count because that was on the way up. So we got 1, 2, and that's okay. Standard Elliott wave says 2, but if we get that third drive back here, we got 1 more to come. 1 more to come. 1 more green accumulation stage, and they may take it in there. You know, Larry Fink, he's laughing his ass off. He's like, "You guys think this market's going up? It ain't going up till I say it goes up." And so he might want to go through 1 more accumulation stage because this is a big opportunity for him to come in and say, hey, this tariff stuff is going to really make the market move. I mean, big bullish for the U.S. economy. But, you know, a lot of the companies that are on the S&P 500, they're international companies, so it could hurt them overseas. Who knows? I don't know. We don't know. We just have to see what Larry Fink wants to do. He's the one that decides. Who's Larry Fink? He's president of BlackRock. BlackRock, Vanguard, and State Street. Those are the 3 guys who get to decide everything. Nobody else in the world gets to decide anything because they own the world. They own everything. They have all the money. All the money in the whole world is owned by those 3 companies. All right, for the most part. All right, here we go. Let's go back over now that we've done that. We're going to do our UBI portfolio. So my UBI. So let's do Utah Tech University UBI portfolio. Here we go. Let's bring it over onto this screen. We'll go full screen on it. There we go. There's where we're at. Now, I think we've had some payoffs. All right, we've got some dividends come out to us. So let me just go through the spreadsheet very quickly so you understand what's going on for those of you who are new. And this section right here is just telling you the stocks that we're considering. The ones that have lines on them like this, everything goes it's a horizontal line. So everything is just one big long horizontal line, all right, like that. That's one trade or one investment. And then we have another investments down here. This is another investment. Now, this says that we put some $5,000 into NVIDIA and we haven't got a payment received yet. This one was Microsoft. So we put some money into Microsoft. So that's all the details for our Microsoft investment. So that's how this works. It's not in rows and columns, but down here it is. So now we come in here. This is YMAG. And you can see that this is all the January stuff. Now this is all February, and this is all the payments we got in March. And then this one only comes in. Now this is because YMAG gets paid every week, right? So we got four per month, 4 payments per month. Now this is this is Misty, and Misty only pays out once per month. So that's why, and it pays pretty big. Look at that. Of course, it depends on how much money you got in it too. Look at the difference between Misty. Let's come in here to Misty, MSTY. Where is it? Right there? So we've got 56,000. Look, $56,000 in Misty, and we have $50,000 in YMAG. Well, over the same period of time, there's a difference, $6,000 difference, but roughly, not that much more. But we made $4,000 in YMAG, and we made $10,000 in Misty. Pretty crazy, right? It's because of the yield. So the yield in Misty is 180%. I don't know if that's correct right now. I think it's gone down. We have to go check our most recent dividends and see. But that's a calculation. You can see the calculation up here. But that might be a little high. But look at this one here, Tesla. Tesla's at 142. NVIDIA's at 100. So this one here, YMAG, is only at 47. See that? Oh, you guys can't. I'm in the way. Here, let's move me over here. Nothing there. There you go. Now you can see down here a little better. So you can see that right here. This is YMAG. Now, YMAG, we've run out of space. So if we get another payment, we're going to have to do a little jig and jog here. We're going to have to say just January and put those 4 into a January. I was going to do that off screen, but we may have to still do it. Okay, we'll do one of them. Show you how I do it. It'll be a good lesson. Okay, now let's come over and look and see if we made any money. So these are the totals over here. So you can see in January, our total was 7,000. February was 7,000. In March, we made 5,700. That's because we had that really nasty, ugly down month, right? And then April's coming in. So far, we've only got 2 payments, 2 little payments. Little Microsoft's not doing a whole lot because we don't have much money in there. What? How much? $497. We ought to just move that into something else. I don't know why we put it into Microsoft. Anyway, we did. Let's see how much money we've got. So difference, total profit loss. See, we're down it. See, we put $54,000 on the shares. We bought our tokens, right? We bought our shares. We paid $54,000 for them, and because the market's been flushing, we're down $18,000. But we still get money. We still get our dividends. The dividends have come in so far. On the dividends, it's given us 6,000. It's given us 11% paid back so far, and that's really mostly what I'm concerned about. This is a little concerning, but it's not the biggest concern because look at how much money it still gives us. Even though the money it's gone down 18,000 in dividends or in the NAV, net asset value, it still keeps kicking out. In this case, this is Tesla, $6,000 in 3 months. Misty, it's down $6,000 on us. So 56,000 has gone to 50,000, which is right there, right? But it still is giving us $10,000 in payment. So it's paid back to us 18% return on that 56,000, and we only have paybacks left 0.64. How many months? 7 months. It will have given us back our entire $56,000. So this becomes almost irrelevant. Not irrelevant. I mean, you kind of feel bad. You're like, well, I'm down $6,000 here. So that just pushes our payback time back. What? How much does it pay us every month? Misty pays us. Misty pays us about $4,000, $2,000, $2,000 or $3,000 a month, and we're down 6. So it's going to push us out 2 months. So at that point, it's just going to extend the payback amount by 2 months because we're down 6,000. It's got to pay that back. Well, it'll take it about 2 months to pay that back. So, yeah, okay, our break even has to go out more than a year. Oh, darn. Right? I know you don't want to have it push out, but that's really all it means. It just means it has to cover the dividends, have to cover those losses, and it's going to take a little bit longer to do it. So, and then once it's all paid back, once it's giving you your full $56,000 back, which is going to happen pretty fast, right? In this case, we got 8 months for it to pay us back. It's a cash cow at that point. I call them cash cows because it's paid back 100% of the amount of money we put in. So we have no more out of pocket risk. And at that point, it's a cash cow. And I say, we're on the gravy train. That's what I say. That's what I call it. Of course, if you keep putting more money in, if you take your dividends, and we take some of this money here, this $10,000, and we put it back in, well, it's going to extend the amount of payoff time because it's going to have to pay back that 10,000 that you just put back in. So it'll just continue as you put more money in. You'll make more money every month, but it'll keep extending the amount of time it's going to take to pay it off. All right, so that's okay too. That's nothing wrong with that. Just keep making more and more money, and there's nothing wrong with that either. All right, so let's go see if we made any money. How's that? So let's come over here. And where are we at? Where are we at? What do we got to do? First thing we got to do is we got to find out if we made any money. So we're going to go start at the top with YMAG. And how do we find that out? We come over here to this little program here. I like to use this little program here because it tells you your dividends. YMAG, YMAG. And here's your little dots here. And so we just come back over here and we look on YMAG. When is the last time we got a payment for 4/3/2025? So where's 4/3? Is it right there? 4/3, April 3rd. That was the last one we made 9 cents. This one here, April 10th, we made the same. 9.7, exactly the same. So we haven't bought any more. I don't know. Do we have any more shares? I don't know. We'll have to do the math and see. But I don't have any room down here. I ran out of room. Can you see that? I'm out of room. So let's make some more room. Here's how I do that. I just come in here and I say, look, okay, we're going to add all these up together. So I can just do it like this. Watch this. I do a little trick. I'll do auto sum and I'll add all those up. I could do that. And that's going to give us one number for that, 1,261.81. I could do that, but then I wouldn't know how much I made on each one, each payment, right? And I kind of like to know that. If I just take the 1,261 and add them all up and say, okay, that was January, and put January in here and put the 1,261 answer, then I lose my granularity. I don't know that I've got 367, a 131, a 263, a 499. And is it important to know that? Maybe not, but I'm kind of one of those guys who likes to know that. All right. Especially if I'm doing it in my real money account and I want to be able to reconcile that at some point. If I just have one number, then I have to go do all the math over. If I can just look at them and see those numbers are still in there, well, then I can see how much I made, the difference. I mean, one month was 367, another month was 131. I kind of want to know that. So what I can do is I just copy those and I put them down here just so I can see them. All right, paste them down there. And then I come in here. I don't need that marching ants. Now I come in here and I got those 4 numbers, right? Just kind of sitting there chilling. So I'm going to change this. This is how I do it. I can just delete all those. And I come in here and I'm just going to make this, and it can't be a date because it'll change it. So I need it back to text, and I'm just going to call it January 2025. Let's abbreviate it so it's not so big. That's that. January 2025. Let's center it so it's pretty. And now we're going to come in here. Now watch how I do this. I'm going to get rid of all these because I got the numbers down here. I don't need them anymore, right? So I'm going to come in here. And I'm going to just clear the content. There we go. Now it changed all the numbers, but that's just temporary while we make this change here. So now I'm going to come in here and I'm going to go up here and I'm going to go equal sign. And I'm going to say equals, and I'm going to do 367.57. And then I'm going to go plus 131.50. And I'm going to go plus 263.001 plus 499.73. Now see how that, I got all those in there, all strung along in there, which are just the numbers from down here that I just copied out of there. So if I hit enter, boom, that should give me a number, 1261. I should come down here, double check my math, auto sum. Is it the same number? 126181. I did it correctly. Okay, so this number is now added back into that column. That column is now correct again, because if you double check the sum, you're going to go auto sum, and it's going to auto sum everything up into there. Boom, just like that. 4,186, and that goes up in here. These numbers all go away. We don't need them anymore. They were just there for reference. Clear content, and it's gone. There you go. Now look, we just freed up 1, 2, 3 spaces. So now I can just grab these and grab them and slide them up. Now, if I want to do that for the rest of them too, because I got January, I got February, I got March. See, I could have a lot of movement in here. So that would be very cool, right? So that's how you can consolidate those. And then if you want to see the individuals, you come here and it's in the formula. So you didn't lose the fact, the granularity, that 1 month you had 367, 1 month you had 131, 1 month you had 263, and 1 month you had 499. It's still there. It's just in the formula. And that way you get all your spacing back. See that? I'm so smart. I'm so smart. How about that? Okay, now we can come down here, and our next one is going to be 5, and it was 1, right? So what was our date? It was April 10th, January, February, March, April. Oh, April is 4. Wait, I got 4 in there. Oh, we already did this one. April 10th? Oh, that's April 3rd. So we got April 10th, and it's going to be the exact same amount, 97. 5, 510, 2025. Okay, and then I can't remember if we bought any more. Let's go look and see. Did we buy any more Misty? The last time we bought Misty was 124. Bought Misty on 124, so it's not going to affect it. So it's, if we don't have to go do the math, because it's going to be exactly the same, 255.12. All right. Now, why didn't that work? It's got to be, there you go. Okay, so, oh no, and it's not 5, it's 4. Because I counted it on my fingers. Okay, 410, 255. See, I'm not the brightest bulb in the box. You guys can do this. See how much I screw up? All right, here we go. So that's our first one, YMAG. So now we made another $255. So far this year on YMAG, on our $50,000 investment, we're up $4,000, which is payback so far. That's 8% return on our 8.9, almost a 9% return in the fourth quarter's. I mean, the first quarter's not even over. We still got 2 more payments. Let's say it's $255. We're going to come out about $5,000 in just the first quarter. That's about 10% return in the first quarter. And if we got 4 quarters and we maintain that, it's 10, 20, 30. That's 40% return on your money on YMAG in 1 year. 40%. I want a 40% return. Okay, go down to Cache Valley Bank, go up to the teller and say, I would like to get 40% return on my money here at Cache Valley Bank. Can I put that in your bank and get 40% return? They're going to tell you to, let's say it all together, go pound red sand. Why red sand? Because we're in southern Utah and all the sand is red down here. All right, John Gaisley says Misty dividends last Friday was $1.34 per share. You doing the research for me, so I have to go look it up. Okay, let's go. So what did you say, John? So 3. So did we get paid? Misty dividends last Friday was $1.34. So we got paid in Misty. Let's go look and see. MSTY. All right, so John's saying we got paid. There it is, $1.33.6. Hey, John, you were off. You said 134. It's actually 133.6. Just kidding. Just kidding. 133.6. All right. So we have to do some math. All right. We have to do math to do this one because we didn't do the math on the other one because it was exactly the same thing. Well, was it exactly the same thing as this one? No, this is 137. So, John, we're going to have to do a little math. Let's pull up our little calculator. Sorry, it's not on the screen. I'm just using my little iPhone calculator here. And so we got one. I'm going to write it down because I got a bad memory. April 10th, 133.6. Okay. So what we're going to do now is we're going to come back over to the spreadsheet. And we're going to come down and Misty. How much do we get to write in here? Again, it was 410. 410.25. And the amount is going to be, we're going to have to take the number of shares we own and multiply it by the dividend, right? So how many shares do we have for Misty? They're right there. We got them listed way over there. See, that's why I changed my whole spreadsheet up. I'm like, those are way over there. I use them all the time. Bring them over here. Make it easier to read. So my new spreadsheet's easier to read. So that is 1936.53 shares. Now remember, they pay you your dividends based on the number of shares you have, not how much you paid for them. So the name of the game is to get as many shares as you can at the lowest price you can possibly pay for them. Now, yes, we worry about how much we paid for our shares, and we can watch the value of our shares go up and down. But if you stop thinking, I tell people all the time, stop thinking about your shares as shares. This is a whole new concept. All right. Start thinking about your shares as tokens. How many tokens do you own? Because they pay you your dividends, and stop calling them dividends. They're distributions. All right. Dividends are shares of a company profits, but these are not that. That's not what they're giving you in these yield max funds. They're giving you the distributions based on options premium that they collected. So it's not even a dividend. It's a distribution. All right. And it's distribution based on the number of tokens you own. All right. It's irrelevant how much you paid for those tokens and how long ago you paid for them. It's all irrelevant. The only thing that matters is how many tokens I have and how much distribution they're going to give me based on the number of tokens I have. And then the only thing I really care about is my payback time. How long is it going to take me to get my initial investment returned to me based on the number of tokens I have? And the lower the token price, the faster they're going to be able to pay it back. But not necessarily, because that means that the value of the distribution might go down too. So it's all relative. It's all just one big mathematical model, but we're not going to get into it that deep. All right. So what we're going to do is we're just going to say, how many tokens do I have? How many tokens? How many shares did I buy? Don't call them shares. Call them tokens. All right. And then once you have your tokens, do you sell your tokens for money? Don't do that. All right. So all right. So we got tokens. How many tokens do we have? We have 1,936 tokens. And how much are they going to give us? They're going to give us $1.33 for each token. So that's $1,936.54. That's how much they're going to give us. So we're going to put that right here. Now it's less than, this is the lowest that we've got. Look, last time was 2,600. This time is 1,936.53. That's because the value of our tokens went down, right? But they'll go back up. It's the whole thing we talked about earlier. We're waiting for them to bottom out and turn and go back up. Those the tokens will go up. So you want to be buying tokens as the price comes down. Dollar cost average, bring your average token price down, and then as the value starts to go back up, you're going to have more tokens, and the tokens will become more expensive, and the percentage that they pay out on those tokens will increase. You'll make more money. That's how the game's played. But that's pretty disappointing to see that it's gone from 4,000 all the way down to 2,000. It's cut in half. That's a 50% discount in our tokens. But also remember, they go through. Did I do something wrong? Jeff's catching me on an error. Oh, that's the number of tokens I have. I didn't do the math. Oh, that's a disappointing thing. No wonder I was disappointed. All right. So now we got to, okay. Thanks for pointing that out, Jeff. My gosh, I'd have had an error a sad error. So 1,936 times 1.336. Oh, thank you, Jeff. So now we're not so bad. I don't feel so bad about it. 2,587.20. That's a little better. Thanks, Jeff. You're like, that's the number of tokens. I got speaking, pontificating, and didn't realize where my math was. Double check your math. All right, so that's not bad. That's still a little lower. We were at 3,900. We're now at 2,500. We got to get our tokens to go back up in value, or we got to bring our average cost down. And since Misty, do we want to put some money back into Misty? That's way down here. That's probably a good place to put some. Look how high it was. It was 46. Now it's 20. So we should put some money back into Misty. Let's see how much we got. So let's see. We got $2,587. We need to be adding that up, huh? Because we've got all this money. We haven't been totaling. Oh, we'll total it right here. So we got this one here. So we got to go put it over here in our total. 255.12. So we're going to put that in YMAG, 255.12. And we're going to do the same thing up here. We're going to go plus this one here. So now we got 510.24. And then this one, Microsoft, we got to come down here and we got to go to Misty. And Misty's going to go equals this one. All right. So now we've got this happening. So we've made $3,100 so far this month. Let's go see what else we've made. Kind of like Easter. It's like little Easter eggs every time you come and find out what you got, how much money you made. So did we get a payment on NVIDIA? NVIDIA says day 5. Did we already get NVIDIA? NVIDIA over here. No, let's go see if we got paid on NVIDIA. Did we get paid on NVIDIA? NVDY. Well, the last one was March 27th. March, NVIDIA. Where is it? March 27th, January, February, March 27th. How come we haven't got paid on that one? Because that says day 5. It's not day 5. It's day 27. So, oh, and we put our money in on 3/24. So why didn't we get paid on that one? We haven't got a single thing on. Wait a second. NVIDIA shows a 3/27/22, and up here it shows nothing. How come that's showing that? We got in, we put 3/24, and we get paid on the 27th, and we put our money in here. Why is it not up there? So let's double check our math. Bruce says the next NVIDIA payment is 4/25, but look, Bruce, on our spreadsheet, we're missing the last one. March 27th, we got paid $787. So that's this one. So we got to take this. How come this formula is gone? Okay, so this equals this. There. Did we get NVIDIA over here? NVIDIA. Oh, we did. We got it put in over here. We just didn't get it put in up there. So I got to bring this formula down here. This formula down here. It's easier to do it this way, I think. Oh, look, it's already over there. That's interesting. Okay, so we'll just get rid of these, clear the content. Clear the content. Okay, so we got our formulas in here for NVIDIA, which were missing before. So at this rate, it will pay us back in 3 more months? No, that's not right. That's not right. If we receive 228, it can't pay you back in 3 months. Months left is 3 months. That's wrong. So if that's wrong, we got that from this formula up here. J6 minus K6. J6 minus K6 divided by S6. MPQRS, monthly income. What in the heck is wrong with that? Well, I think we got some errors in this sheet, guys. I'm going to have to go check this. All right, I'll check it. I won't sit here and debug the sheet while you guys are watching, but I don't think this is right. I think we got an error in that column right there because that doesn't look right. You can't get that paid back in 3 months. And that's 13 months with this. That doesn't seem right. I'll go look into it. All right. So that one is Misty, and Bruce is saying we're in here at 27. If you do this with your real money account, this math is all done for you. All this calculation over here. So all you have to do is just enter it here and there, and it's all done. But we have to make sure the sheet's correct. And I feel bad that sheet's. And Bruce is saying this is day 25. Okay. All right. If Misty pays dividends on about the 11th or the 14th of the month, when do you have to be in the ETF to get? You have to be in by the ex-dividend date, which is usually a couple days before. So if they pay on Friday, you have to be in like on Wednesday. But it's not exactly that day. They send out an email or they'll post it on their website what the day that they specify what the date is. So you have to have your money in by that date. And I know a lot of people are like, well, I'll just put my money in on that date and then pull it back out the date after. So I get all this money and not have to leave my money in there. It's called dividend hunting, and you can try that, but it doesn't work very good. It doesn't work very well. And the reason is because think about this as a bucket of money. All right. And so they're out here trading options and they throw all the money into the bucket. They keep filling the bucket with money. Right. And you're like, well, they're going to make a distribution on, next Friday. So to get my distribution, I'm going to cheat the system and I'm going to go in and I'm going to put my money in just 2 days before they pull the money out to distribute it to everybody. But then as soon as they've pulled it all out and distributed it to everybody, I'm going to pull my money out. And then I'm not going to be in the market for a whole month. And then I'll just put it back, 2 weeks before and I'll do it again. People try that. The problem with that is that as soon as they put the money into the bucket, right? And so the bucket kind of rises as they put the money in, and they put the money in every day or whenever their options expire, they put the money into the bucket. Now our money's into this bucket too. So then what happens is they say, well, it's a distribution day. So they pull all the money out and start distributing it to us. Well, what happens to the bucket when that happens? The value of the bucket goes down, which is the share price. So if the value of the share price is flush when they pull the money out to give it to a distribution, and your idea is I'm going to put it in before and I'm going to take it out after, well, the bucket generally flushes about the same amount that they paid out. So you're like, I'm going to put my money in, they're going to give me $10,000, I'm going to lose $10,000, and then I'm going to pull it back out. So it generally doesn't work. But you can try it because over the next, month, they're going to start putting money back into the bucket, and the bucket should continue to rise in value before they pull money back out. And then so it's all a big game you can play, and you can try and do that, but it usually ends up not working out for you. That's why it's not taught very, very much as a strategy. Sometimes it works great because the bucket will rise right back up, or the bucket doesn't ever go down. You never know what the bucket's going to do. But usually when they make a distribution, the bucket flushes down because they take all the money out of the bucket. So then you think, well, I'm going to take my money out. Well, you take your money out after the market already flushed. And then you lose it in the value of your shares. So, and then you also, if you're doing it in a normal account, you're also having every month that you do that, or every time you do that, you have a taxable event. So keep that in mind too. All right. I think that's all we have. I don't think we got a payment on anything else. Just those two, Misty and YMAG. And I think I got an error in my spreadsheet. So I'm going to spend some time looking at that. So we got some money on YMAG. We got some money on Misty. Tesla's the next. Tesla and NVIDIA are the other two that we've still got. So let's go look over and see when they come in. Tesla, TSLY. Now, the question is, should I buy some Tesla? Should I put some money into Tesla? Well, this is Tesla. So don't ever look at Tesla to decide whether you want to put money in it. Because remember, Tesla is just the bucket. All right. It doesn't really, and it's not a representation of the underlying stock, which is Tesla. You always only want to decide whether you want to put money into Tesla if you want to put money into Tesla. So you come over to TSLA and you're like, well, would I put money into Tesla? Then you look at it and you say, oh, well, I don't know. Looks pretty good to me. Might want to buy some low. This is pretty low. It's about as low as Tesla's been in a long time. So you're like, okay, I want to buy some Tesla. Well, you don't put it into Tesla. That's the growth. And you can do that certainly too. Nothing wrong with putting money into Tesla. It's just not going to give you a big dividend. All right. It's not going to give you payments every month. So then we're going to come back over to Tesla, TSLY. And this is the one we would put the money in to get our dividends. And we say, okay, well, last time it paid out a dividend of 46 cents per share. And it depends on how many shares you buy, right? So it's been going sideways. It's not been flushing down. So probably a good time to go through the accumulation stage. I bet you if we went over, let's go look Tesla on track and trade. Where is it? Let's go look at Tesla, TSLA. It's probably already up. There it is. Tesla. And the accumulation stage is still relatively small. But look at this big accumulation stage. So obviously that's what has to happen for these big banks. So this market comes down, they have to all the retail traders, all of us guys, right? We're selling all the way down here. Well, somebody's got to buy it from us, and that's the big banks and hedge funds. They're buying it all the way down this whole trend. Now it starts to go sideways, and they generally, this is their standard accumulation area. So this is where they really start loading up down in here. And so they've been dollar cost averaging all the way down. So as they sell, their average price, let's just call this their average price. Let's say right up in here, they start to see this little thing right here. They start to all the retail traders start to buy, right? Or start to sell. So for every seller, there's got to be a buyer. Well, who's buying the stuff that the retail traders are selling? Got this big thing right here, this big run up. Come on. Pull that up. So it's going to go through this stage once again. Why can't I grab that? I hate this thing sometimes. Okay. So you come in here and it's this stage right here, right? As we come through this pattern. So here's we're all the way up through the entire, we're up here at euphoria, exuberance, and euphoria right up in here. And then this is where we like to start to buy up in here. So we buy up in here, but then the market comes over and we start to sell. Anxiety and denial and fear. So that's what happened here. This is the anxiety, denial, and fear. This is where we start to sell out. So the big banks and big boys, they have to buy up in there. All right. Because you're selling, somebody's got to buy, and that's their job. So they'll start to buy. So they have to buy right up in there. But that's not really advantageous for them to be buying up in there. So they're going to start to buy, but they're going to have to drive this market down to bring their average price down. So as they start to buy all the way down this downtrend, as the retail traders start to jump ship, right? As they go through anxiety, denial, fear, despair, panic, capitulation, discouragement, and then that's the final sellout down in here. The big banks and hedge funds, BlackRock, they've been buying all these up. So that's why this is green down in here. Now we're going through the accumulation stage. Remember, I told you, I said, I don't think it's just going to go straight back up. And the reason is because this is too big of an opportunity for these guys. They're looking at this as like, oh my gosh, we're going to make more money than God on this thing. And so they're going to come in through here. And so this is the discouragement and the dismay. That's what's going on here. And now they're starting to get this, see this dismay, and it turns to hope. So this is the retailer, small retailers, not the big banks. So they start to get hope in here, and that's what they want. They want the big banks. They've got their dollar cost average moved all the way down in here, and the more they want to pull their average down, the longer this will be. All right, the longer this will go sideways. They just keep buying and buying and buying and buying and buying and through here. You're like, but if they start to buy land, doesn't the market go up? No, because they do something called accumulation. So they'll buy 10, they'll sell 9. They'll buy 10, they'll sell 9. They'll buy 10, they'll sell 9. And after a while, they build up a huge position without driving the market higher. So that's why it gets real choppy through here. And it's just called the accumulation stage. Oh, Lan, you're making that up. No, I'm not. Look, there it is right there. This is called the Wyckoff accumulation distribution model. I ain't making it up. I was taught this at the Chicago Board of Trade 30 years ago. All right. I don't know, has it been 30 years? No, it's not been 30 years since I was there. It's been 20 years since I was back there. So see this is the state. Look at this. It's just like a train on rails. Look at this is your accumulation stage right down here. Start the accumulation. Okay. And then they fire it off and up there. Look at that. It's almost as if you drew it. You couldn't have drawn it any better. You could take a snapshot of this picture right here and use it in the manual as an example of this drawing of how the accumulation distribution stage goes. So you go over here, you get this thing here, you get the little drop down, which is this little drop down here. You get the little sideways thing, which is right there. You get another drop and it's going sideways. Where are we at? Where are we at in that? I mean, it just doesn't get any better than that, does it? You'd think that I drew this picture based on what I saw here. Oh my hell. It's like a train on rails. This thing is acting like a train on rails. I try to tell you guys, it's all one big mathematical model formula. It's all being driven by the big quants and the hedge funds. And if you don't think so, look at that picture right there. This picture was drawn years ago. I drew that picture years ago. In fact, I'm not sure this is the one I drew. This might be one stole off the internet. I drew. It looks like mine. Can't tell. Mine looks the same. Anyway, that's it, man. Look at this. Look at this. Look at this. Where are we? Is it like a map or what? It's like a map to the treasure hunt. I just should snap a picture of that and leave it there and just say, that's it. That's it. If there's nothing more classic, that's the most classic move right there I've ever seen. That is so classic. Are you guys seeing that with me? I don't know. Just like raises the hair on the back of your neck, doesn't it? So where are we? We're right here. You want to buy into that, baby? Buy, buy, buy. It looks like it to me. It looks like it to me. Looks like you want to back the truck up. You want to sell the farm. You want to sell the house, sell the children, sell the wife. Whatever you can do to raise money. And put it into Tesla right now, because that baby right there, I don't know. You don't believe it. I know. Like a train on rails. Okay, so there we go, guys. That's all I got for you today. I'm gonna let you go. But these markets, they're all driven by BlackRock, by Vanguard, and by State Street. And they do it with their quant systems, their mathematical models. And it's just the way they trade. It's just how they do it. So if we can reverse engineer that, and we can identify these patterns that are happening in these markets, we can take advantage of it too and do what they do. That's all there is to it. All right. I'm going to let you guys go. If you had fun today and you learned anything, go ahead and hit that little thumbs up. I always love it when you guys hit the thumbs up. And we will catch you tomorrow afternoon for some day trading. All right. 1 o'clock in the afternoon, Mountain Standard Time. Same place, same bat channel, same bat cave. And we'll do it right here. And we'll trade some day trades. All right. We'll see you.